If you're looking for proven strategies on how to trade in this very volatile environment, then you have found the right place. You have found Riz International, and I want to suggest that you go ahead right now, if you haven't done so already, go ahead and click that like and subscribe button down below. It really helps us grow the channel so that we can reach more traders like yourself who want to learn about the markets and learn how to trade in uncertain times. And we are joined tonight by the man himself, Rizwan Memon. Riz, how you doing tonight, buddy?
I'm well, sir. How about yourself?
I cannot complain. It is a beautiful night here in Indiana where I live. I hope things are going well for you up in Canada. And we have got a lot to talk about. It has been a wild week, to say the least. Market has been on an absolute tear starting on Tuesday, and it just did not quit even going into Friday. And I mean, we had the rate hike that looked like it was going to pull the market back down, and then the market just completely rallied the whole time. Monday was looking pretty sketchy. We closed below that 4,200 level that we've been watching, and it has really provided a lot of support so far. And it did it again. We were able to buy into it on Tuesday, and the market just ripped after that. Riz, how do you explain this breakout? Because we were in a strong downtrend, and now it looks like we're trending upwards a little bit.
Yeah, this is massive rally. I think maybe this is a bit of a trade the post-Fed rate hike type of environment where we saw the 25 basis point rate hike. The Fed did say, we're anticipating another six. But you know what? The market obviously knew that the 25 basis point hike was coming. We just needed confirmation. We just needed that catalyst to be done and over with. And you know what? I don't think Powell said anything too shockingly from left field. Pretty much what the market expected. He also said that inflation is expected to come down in the second half, and we might see 4%, 3 to 4% range, which is pretty much the best case scenario, the 3% range in 2023. Again, that's the Federal Reserve's sort of projection. We know their projections can be wrong, quite wrong, in fact, as we've seen. So really, that remains to be seen. But the market, really had a bit of a dip buy kind of scenario with the 4,200 level, as we saw. In fact, I added it to my positions, and I let elite members know as well. When we saw that 42 and a half, 42.50 area, and I added to my positions that I already have open. Just because to deploy a little bit more capital, that cash that I had on hand as well. So you know what? I still have some cash. I have some great positions open. Many are in the red, but that's completely fine because they're solid large caps that are, I believe, at a great forward. Have a lot of forward-looking momentum. It's just when the market environment does align, when we start going into solid economic prospects, then the market should realign eventually as well. But for now, this whole Russia and Ukraine situation continues. But I think the market is slowly um, digesting it and accepting this kind of volatility, this kind of scenario in Eastern Europe, and it's kind of rolling with it. We saw something like this happen in 2020 when the pandemic finally happened and the market started digesting the fact that, okay, maybe a vaccine will come sooner than later. Maybe this isn't the end of the world. That, yeah, it's very alarming. It's a horrible thing, and it can have a negative impact in all aspects of life, but it's not going to be the end of humanity. And as a result, the market started recovering, right? And it started recovering well ahead of the economy. So one thing we always must remember is the market is not the economy, and the economy is not the market. This is something a lot of beginners um, get confused about. They think, oh, the market is down 10%, so we're in a recession. No, a recession is completely separate, right? Do these things have sort of a correlation? Do they have some relevance? Absolutely. We do know the market is usually a leading indicator. in terms of economics, right? So we see if the markets recover, we can see eventually that trickle into the economic recovery. If we see markets fade big time, that could say that perhaps this leads the economy to slow down too. So the market is actually uh, a leading indicator, right? So for me, it wasn't surprising when the markets were recovering 2020, tail end of 2020 and 2021, as you can see with this chart. But obviously, a lot of people were crying foul and they're calling for a crash and they're calling for, well, how could this be? The economy is slowing and blah, blah, blah. When it wasn't, it was actually recovering and the market already figured that out and was well on its way to breaking highs after highs after highs. And I got to see it, and most of us probably on this webinar or watching this live or the recording got to see it in front of our eyes. It was sort of unprecedented because how could this happen? How could this once in a lifetime, once in 100-year type of pandemic happen? And it takes a toll on the global economy, and the market continues to get past it. And it was one of the fastest drops um, ever in the stock market history, and it was also the fastest recovery as well. So we lived through a pretty unprecedented time, and I think now we're still in unprecedented times. With you know war and on the Eastern Front and potential for other countries to get involved. Although I don't think that's going to happen. That was a big fear of markets of this being sort of like a oh no, World War III scenario. And all memes and jokes aside, I hopefully that's never the case. But I think the market's digesting that, right? As Chris has highlighted, we have been in this kind of downtrend that really broke out really on Wednesday and Thursday and Friday, especially right up against that. What is it? I believe it's the 200-day moving average, Chris, the white line.
Yeah, that's the
Um,
200.
yeah, so it's right up against the 200. I also mentioned to elite members last week that the reason we don't want to get too happy is, this could be a kind of a relief rally, and we may see some selling, some profit taking on this, right? And we have to keep in mind that the 50-day moving average did cross below the 200-day moving average right there, as Chris is drawing a circle on. So does that mean the end of the world or the end of the stock market and we're going to see a crash? Absolutely not. It just means that technicals, the short-term trend is downwards compared to the long-term trend. That's what it's telling you. And that's usually seen as a bearish sentiment, a bearish price action potentially, right? There's no guarantee, obviously, in technical analysis, but there's something to keep in mind. But yeah, this week's rally has been unprecedented. A lot of people have been pretty upbeat, and I'm glad. Obviously, when everyone's more upbeat and happier as opposed to seeing red in their portfolio every day, day after day. So this is good. What we do want to do is we want to be cognizant. We want to know what we have and manage those positions. If you have profits, I always say take some profits, let some run in this scenario. If you have stocks that you're not in profit in and you're still in the red in, well, you can carry the whole, continue carrying so long as they're great companies, as long as they're not like garbage penny stocks and pump and dumps and highly speculative biotech stuff like that. You don't want to bag hold. But if you're holding great companies at good prices, um, then it's just a matter of time where things really start coming back. If you believe that the economy will continue to move along, that inflation will, sort itself out, and that rate hikes will sort of balance the economy, won't be so um, frothy like it's been over the last couple of years.
So I want to. That was a great analysis, by the way, and thank you for sharing that. And I kind of want to touch on the inflation issue because it seems that we've that's kind of gone by the wayside ever since Russia invaded Ukraine, but it's still a very pertinent issue right now. And the rate hikes, from my understanding, are designed to try and curtail that. What's the rationale behind that, Riz, for raising interest rates to kind of help inflation?
Yeah, so without getting into the nitty-gritty and keeping it high level and simplistic, inflation is obviously the erosion of the value of the dollar or any currency, because inflation is everywhere. Inflation is a normal thing, and normal ranges usually range between 2 to 3% annual. What we've been seeing is obviously a multiple of that. In fact, the most recent inflation print came in at 7.9% annualized. So you can see the big difference, right? So how do you combat that? How do you combat inflation? Um, well, first, why does inflation happen? Inflation happens because of loose monetary policy, which we saw, in 2020, 2021, where there's a lot of money printing, there's a lot of stimulus, there's, easy lending, and low rates. So that's all pumps the economy. That all kind of juices the economy. It's like it like puts steroids in it, right? And what happens is you can get runway inflation like we're seeing now, 8% on average, right? Give or take, average. It doesn't, when groceries could be gone up 20%. House prices could be gone up 15%. Gas prices gone up, 50%. So remember, it's just the average. So the average person is paying at least 8% more on pretty much everything on average. So the Federal Reserve is in charge of making sure that the economy is balanced. It doesn't go from you know bubble to crash. It doesn't go from one extreme to the other. That's really the Federal Reserve's mandate. Um, and how do they control something like inflation? Well, the only option they really have after all the money printing and easy money and low rates is to raise rates. Really, this is the only tool they have left. Um, because rates have been near low, the real rates are actually negative after you factor in inflation, meaning it's actually beneficial to borrow, right? So they're doing that. They started that. This is the first rate hike since I believe end of 2018. um, so this is, something that's been on the cards. I wish they would have started this process sooner, but hey, that's the Fed for you, sleep at the wheel, right? So when they raise rates, this increases the cost of borrowing. A cost of borrowing increasing not only impacts the average person, but it impacts large corporations. Corporations have debt, most of them. They borrow capital too in large sums. So the cost of borrowing goes up, capital spending goes down. Um, you know, Companies and corporations borrow less money, they use less money to grow. In fact, the average person usually reins in their checkbook because they know that it's going to cost more to borrow. Instead of getting that shiny new car, someone might say, I'll get something a few years older. These are the simple, I mean, I'm really bringing it down to the basics, but these are the kind of things we see. People thinking, okay, let me remortgage the house at this favorable rate so then I can go and buy a couple other properties on leverage. May think twice about doing that because the rates are going up. Again, this takes time. It's very much higher than we want. The inflation is much higher than where we want it to be. Rates have a long way to catch up. There's going to be, and I see the comments coming in, which I will get to later on. But yes, economically, we're in a situation unlike before, and this is really what's known as modern monetary theory. MMT, where we have record low rates, a lot of stimulus, um, record high inflation, record high meaning in the last 40 years is the highest it's been in the last 40 years. I'm not even 40 years old. I'm 30, so I've never seen this kind of inflation in my life. In fact, many people haven't, right? So we're really in uncharted territory still. And maybe this is the new normal, you know? Um, so it's something interesting that we're all going through. And I assure you, no economic policy or no economist really can tell you, oh, this is what's going to happen, or oh, this is going to work, or oh, modern monetary theory is the right way, or traditional monetary policy is the right way. No one really has a clear answer, and this is one of the biggest problems with economists and all these talking heads. Yeah, they can do their analysis. Yeah, they can rely on their past experiences and their you know studies and all the stuff that they've done, but really the real world, if we learn anything in the last couple of years, it's the real world has a shockingly absurd way of letting us know as human beings that, well, we don't know as much as we think and we're not always right. So this is something that we have to take as it comes. I know it's been a long-winded answer, but really, we need rates to go up, and we need them to go up sooner rather than later. And as I mentioned in the start of the webinar, that we're anticipating 6 rate hikes, most being 25 basis points. Maybe, just maybe, there might be one snuck in there about 50 basis points. So 0.50%, perhaps. But this needs to happen. Otherwise, inflation is just gonna stay. It's gonna stay high, and that's gonna have a really, really bad impact on not only the average consumer, but of course the stock market.
Great questions here in the chat. We will get to those at the end. I want to keep moving here so we can kind of get our recap going, but we'll come back to this topic here when we do the Q&A. Honestly, a little bit more of the same here when we're looking at the breakdown for the S&P 500 so far this year. Basically, everything is below the zero line except for energy, and we kind of know what's propping that up. Though I will say we are seeing a nice uptrend here with this rally in the market. We are starting to see these indices start to push back towards that zero line, see if we can't get back up over zero on the year. Utility is doing the best so far, just basically 0.1% below the zero line, so basically break even. But yeah, tech's still lagging, but looks like it's starting to curl back towards the upside with the upswing in the market. Anything in particular here that's interesting to you, Riz?
No, I think the only thing that I wanted to mention is I'm hoping we see obviously the energy, XLE, the energy um, sector of the S&P 500, it's the ETF for the energy sector. So it's not a direct correlation to oil prices, but there is a strong correlation there. It's not one to one, but it is a strong correlation. I'm hoping that we do see a pullback in oil. We did see a pullback in oil from like what 135 or something, Chris? Yeah, like 130. Yeah,
130.
130. I'm hoping we do see a continuation of the pullback. We did trade puts on oil, USO, not this week, but the week prior, and we made some money on that fade lower. When we got it, we took some profits, and I'm glad we did because oil did rally back above that $100 mark. I'm hoping we do see a further pullback and reversion to the mean, and who knows, maybe there's another oil trade coming in, setting up perhaps. Wink, wink. For those of you in elite, but we'll see. Interesting times ahead. But yeah, I'm hoping oil prices do pull back, and as a result, if oil prices do, I think the energy sector for the S&P 500 will also kind of pull back a little bit.
Absolutely, yeah. Of course, the energy ETF isn't completely ruled by crude oil, but I mean let's be honest, that's what's propping it up right now. With this massive run up in oil, of course, with the conflict in eastern Ukraine, with the embargo on Russian oil, and different talks going on in Iran and with other nationalities who supply crude oil, it is a very volatile time in the black gold market, as I like to refer to it. But yeah, we made this run up here to 130, looks like on the 7th of March, and then it kind of pulled back from there, bouncing nicely off this 95 area thereabouts, and just closing on Friday just above 103 per barrel. Now, gold has been on a bit of a tear here, but has conveniently come right back into the channel that it's been in for the last year and a half, essentially. Of course, there was a big run-up with war and inflation and things like that. People flocking to what they know. And the old hedge against inflation is gold. Now, I'll say it has not been behaving as a hedge against inflation as of late, but this run-up was rather interesting, and then it just came right back down. And honestly, somewhat mirroring the pattern that we're seeing on oil here. But yeah, not too... I mean, for me personally, nothing really interesting here on gold. Yeah, we did push up close to 2080 per ounce, but then it just came right back down. Now we're back in the 1920 range, so a bit of volatility there. Riz, do you have anything else you'd like to add to this?
No, nothing on gold. Really, not something I'm too enamored by.
Exactly. Diamonds are a girl's best friend anyway. All right, let's take a look at crypto because whenever you talk about inflation and central banks, people are like, "Oh, we need to get, decentralized currency." And you would think that crypto would just be going flipping nuts right now, and it is not. Now, I will say that Bitcoin did push back over this 40,000 area that had been causing it some problems. But if you look at this, we're still in a downtrend on Bitcoin right now. And until we bust out about over 46,000, I'm going to say, that's going to be my line in the sand, so to speak. Until we bust out over that, I'm still saying crypto's in a bit of a downtrend here.
Yeah, no, I agree. I think we were seeing a little bit of a channel sideways consolidation for the last couple of months. This 40,000 is a big key level. If we see below 40,000, that's where it gets interesting, right? Because then maybe we see, 38, 36, 36 kind of is like that support area. And of course, the hard line in the sand is 30,000, but we haven't seen that since uh, last July,
Yep.
right?
Yep.
So, you know, keeping an eye on it, but no position for me currently in crypto. I just find there's far too much more viable setups and opportunities outside of crypto. But that's just me.
Absolutely. And of course, trade at your own risk. We're not trying to give you financial advice or tell you what to take positions in. We're just letting you know where we are. Let's go to some questions here because there's a lot more questions around inflation. And what is it, CPI? Do we have? I don't know. Is there a ticker for the consumer price index, Riz?
Yeah, I don't know if they're able to bring up the maybe there's it's under the economy thing, but I don't know if TradingView will be able to bring it up. I do know that CPI came in around probably about 7.9, right? Might have to scroll down. United States core CPI, try that. No, yeah.
No, that's not it. Okay, never mind. It was a cool
There's
idea. We'll
CPI
do.
is different consumer price index, so that could be right for the consumer price index. But overall, when we look at total inflation, um, we're looking at it again annualized. This was annualized, and it's about 7.9. So CPI number on that one, on that indicator you brought up there, did look right for CPI.
Okay,
Again,
fair enough.
I'd have to look at it closely, but ultimately, we are seeing an 8% inflation rate right now. The Fed is already done their first rate hike. We are anticipating six more. There are some investment banks that think maybe we might see uh, eight total, so another seven. But I don't even know if that's going to happen. If this Russia-Ukraine situation gets worse or it starts having a bigger impact on supply chains, um, I think we might see. I think the Fed perhaps start to adjust and start factoring that in. So there's something to think about. Just my 2 cents. And as Chris tries to bring up the uh, inflation rate,
Yeah, I'm not seeing that one, Yas. Okay,
yeah, just type in rate.
it would help if I could type.
No, nothing coming up.
Yeah, nothing here.
Oh,
Okay, we have a link. Let me try it. We can't open that chart layout. I'm not cool enough to have that.
yeah,
TradingView says no. No to me. I'm not cool.
yeah.
All right, so
Um,
let's tackle some of these questions. So Yas asks, he says, inflation is still higher than benchmark rates. Is it still beneficial for companies to borrow money right now?
Yeah, so that's a good question. The real rate of interest, right? So real rates equal benchmark rates minus inflation. So yes, right now it still makes sense, but they have to be tricky with that. They have to be tricky with that because these companies don't necessarily have small lines of credit so they can easily, shore up and then, just close off. These are large shelves. These are large revolving lines. They have a lot of let's just say fine print. They have a lot of conditions, and they don't necessarily want to be exposed to all of that just yet. They need some stability. So here's what happens: what if we get rising rates plus decreasing inflation. Notice how that can be a bad situation for companies to be in. In other words, it can be a bit too much uncertainty. So does this mean that companies are completely stop borrowing? Absolutely not. No, it's not like they've completely pulled the plug and not borrowing. No, I think many companies, especially growth stocks, um, have to continue to borrow, and it just means that their borrowing costs are going to go up. It makes it less beneficial. Is it still beneficial? Absolutely, depending on how they do it, depending on the structure of the term and the rate. Yes, it's definitely still viable for these large corporations. For the average person to borrow, yeah, of course, that comes down purely to affordability. So that's a very different story for when it comes to personal borrowing. But in terms of corporations, large corporations borrowing capital for reinvestment and growth, yes, it's definitely still viable. But that gap is going to bridge if we see rates continue to go up and inflation come down. It's going to make it less and less worth it, okay, compared to last year or even the beginning of this year.
Absolutely. No, I can definitely tell you interest rates are rising here for borrowing for personal. But Evgeny mentions the last time that inflation was about 8%, rates were around 10%. If I'm not mistaken, that was back in the 70s, if not higher. Do you really think that a 25 or 50 basis point hike will make any difference to stifle inflation? Could we have could we have unexpectedly Powell go full Volcker sometime during this year? And if so, how much? How would such a move impact stocks? I mean, I think if they go nuts on the interest rates, the market's going to tank. If it's more than, I think the reason they're raising it so slow is so that the shock is not so high. But Riz, what's your thoughts on that?
Yeah, no, I agree. I think Evgeny brings a great point, a very uh, candid and valid point that like the last time 40 years ago when inflation rates were 8%, we had the average benchmark rate at 10%. So if the benchmark rate is 10%, you can expect your car loan to be around 15%. Now with inflation at 8%, the average car loan is around 4 to 5, right? With benchmark rates being like 1%, not even. So yes, there's a massive, massive difference. But of course, the thing is, there's also a huge difference between 1980s and now. The economy, the GDP, the efficiency and productivity of the workforce, how we work, how we communicate, how we commute, how we travel, everything has changed from 1980 significantly. All right. So yes, in a bubble, in a vacuum, all things considered, yes, it's a massive kind of discourse there where there's not it's not adding up, it's not aligning. But for this economy, for the situation that we're in, right off of a 2-year type of pandemic situation, um, where a lot of economic uh, support was needed, that's a very different situation, right, compared to the 80s. So all things said and done, as Chris said, I don't think Powell and the Federal Reserve wants to raise rates too quickly. They don't want to have a crash or an economic, uh, literally meltdown on their hands. So they rather do it more slower than faster. In fact, I think that was their whole thing. They thought that they could get away with not raising rates too quickly, or because they thought inflation would get itself back in check. Obviously, they were wrong. So now they're raising rates at a little bit of a faster clip than expected. I mean, having 6 rate hikes in a year isn't necessarily minimal, right? So if we see 25 basis points rate hikes, 6 of them, we're looking at 3% increase for the year. Um, Apart from what the benchmark rates, which is near zero anyway. So let's just say we go to 3% benchmark rate by the end of the year. That's still a sizable increase, right? From near zero to three, that's a sizable increase, right? So I do think it will stifle inflation. I do think it will. Um, Not just with a 25 basis point increase, but after we see things cool off. We've seen a massive supply crunch. One of the reasons we've seen the supply crunch, and remember, supply crunch is factoring in to inflation. All right, there's no doubt about it. So once we see inflation get in control. How are we going to do that? Hopefully, again, hopefully, interest rates go up, lending costs go up. The average person and obviously corporation is kind of being more conservative with how they spend and what they purchase and what they do with their capital. Um, and as a result, that should pull back inflation. And once inflation comes down, once the average consumer and corporation is not consuming as much, they're not purchasing as much. Hopefully, that gives enough time to the supply chain, to the production side of things, to catch up, right? So we things like semiconductors, things like um, raw materials, things like that you need in even things like grocery items, right? If we were People are running off out of things on their shelf, they're seeing things on the shelf. What things used to be there before are no longer there, just empty, right? Or they're replaced by other things. So hopefully we're able to see the supply chain catch up, right? um, and the whole recession talk, is definitely there, is definitely more likely, but then let's say, if you would have asked me last year when there were no rate hikes, and when inflation wasn't 8%, it was more so 4.5, 5. So yes, there's talks of recession coming in, maybe second half of 2022. But remember, people have been calling for a recession uh, since the last one, right? And we had one of the shortest recessions of all time in 2020, right? Again, not bear markets, not markets, but recessions, right? So the economic situation uh, was unprecedented in 2020. So really, do we want to call that a recession? Um, Even do we want to call this what happened with Chris Circle a bear market? I don't know. I don't know if you want to call it, you know, an actual cyclical bear market. And I don't know if you want to really call this what happened in the economy in 2020 as actual uh, secular recession. So I feel like, yeah, maybe we could see a slowdown in the economy, but recessions aren't necessarily a bad thing. Every time people think about recession before 2020 and everything that happened in 2020 is 2008, 2009. That's it. Every time the word recession is mentioned, that's what people think about. So I want to draw people's attention to the fact that that's not always what a recession is. That was a very bad recession. It was a meltdown in the financial system. And I'm not going to go through the fine details of that, but that was a very significant recession. That's why they called it the Great Recession, right? Because it was a recession, but a really, really bad one. There's been other recessions in the economy since the start of history that haven't necessarily been as extreme, as uh, long, or as perilous, right? So recessions are seen as a swear word. And I don't know really likes recession. It means to slow down spending, the economy, blah blah blah. But it's not the end of the world, right? It's a natural part. It's a needed part of the economic cycle. And I've written a lot about the economic cycle. In fact, there's a lot of documents I've written up and shared with elite members and masterclass students on the economic cycle. Um, so really, this is an important part. It's not something that I would be afraid of. It's not something that I would try and forecast just yet. We could see a slowdown. Remember, if we see a slowdown in GDP, um, and it doesn't collapse, it could still be a slowdown in GDP, but still not a recession, right? In order to have a recession, you need a decline in GDP, I think like 3 consecutive quarters or something. So you know what? Remains to be seen. 2022, second half, maybe. I mean, when you think about it, we're already almost in April of 2022. So yeah, it remains to be seen.
Now, Lloyd has an idea on how he thinks that the Fed can curb inflation. He says, can the Fed raise reserve requirements at banks in order to constrain the supply of money while also raising rates, essentially removing money from the market?
Well, can they or can they not? I can't answer. I don't know if they really can, and all the minor details surrounding that. But what you mentioned is, in terms of monetary supply, monetary theory, those things are very hard to do. Like, you can't tell the bank, okay, stop giving money out. How do they do it? They won't be able to say, okay, stop giving money out. How are they doing it? Well, they control the top level, aka rates. aka the balance sheet. How much money the Federal Reserve has on their balance sheet. You probably heard, um, tapering. You've heard the word tapering. You've heard the word, Fed balance sheet. You've heard the word, Fed buying assets, aka bonds. So these are the ways they control monetary policy from a high level. Will they tell, like, your local branch or the entire network of, let's say, Bank of America or Wells Fargo or something, hey, stop giving out this money for lending? No, they can't really do that, because once the banks have that money, that's theirs to disperse and dispose of. That's why they have to let the free market decide what's worth borrowing, what's worth not borrowing. It's They want to leave it up to the banks to make sure that they're following their risk parameters, make sure that they meet these requirements, and they're not taking on too much leverage, or they're not lending to subprime too much, or they don't have too much garbage assets on their books like they did in 2008. So those are all the regulations and stuff that they have in place. I don't know if they're going to be able to, or if they even can, or are allowed to even say, um, controlling that reserve requirement for the banks. I don't think so. I don't think they're going to be like, hey guys, you have to carry this much assets on your books. They have done in the past, but I don't think it warrants that right now. Right? You have to carry this much cash on your books. They do have strict um, risk requirements, and I'm blanking on the word, but uh, those are still there. They've been there since 2009 or 10 or whatever, when they really put it in place. But for now, um, I think, in a nutshell, increasing rates is a healthy part of the economy. Obviously, no one likes rates going up because it increases their cost of borrowing, if that's a line of credit, or if that's their open car loan, or if that's their um, you know private lending, whatever the case is. No one likes rates going up, but I think it's, in the large picture, the big picture, I think it's required, it's necessary. Um, and I think I'm glad that it's happening now. It's a bit late, but at least it's happening now rather than later.
All right, so Yas has a question about has a ticker about, a stock that's kind of on our blacklist right now. Yas wants to know about Baba. With the recent development of China willing to support their listing in foreign markets, I know that in elite, it's kind of a dirty word, but sometimes do rules need to be broken? What are your thoughts on Baba, Riz?
Yeah. So personally, I mean, not for me. I mean, yeah, it staged a great comeback. I think it was up like 30% in one day. But of course, when you look at it, it's like, wow, an absolute meltdown. Chris, what was the high on this thing last year, or 2020? Uh,
319.
oh my lord, yeah. So what is that? Nearly a 66% or something.
Yeah, just
Uh,
about.
Drop. It was 75 at the start of the week, I think. Right. So,
Yeah, if we go to the start of the week, it's a
oh lord,
76% drop. If we go where we close, it's about
okay,
yeah,
you guys,
66.
my math is still on point, right?
Solid.
um. So, you know, a case can definitely be made, yes, on going long on this, especially like a bullish breakout, momentum trade, all that buzzwords. Um, Personally, not for me. It could definitely be seen as a turnaround play. I know there's some large institutions, especially Charlie Munger. I mean, I'm not going to go into Charlie Munger's. If you don't know who he is, then maybe you have some homework to do. But Charlie Munger, I know, has a position. He's bullish. But hey, um, Charlie's like knocking on 100 years old almost, and he can be wrong. All due respect to him. So really, I feel like I rather put my money in other companies personally. Um, so personally, for me, there's a lot of people um, who can lean on either side of the camp, and I can't really blame one or the other. If you feel like going long, if it suits your risk tolerance, and you can have a hard stop on it, absolutely play this like a technical trade. Maybe you have a hard stop at 80, or maybe even if you're very conservative, around 95 or 100, and then see if this sucker can run above 120, 125. Right? Perhaps it can, with the right uh, wording and the right moves on Chinese authorities, plus a rally in the market mixed. Yeah, this thing can be a runner.
Don't forget, with those Chinese stocks, you need the blessing of the CCP. Awesome.
Any other question? I'm trying to see if I see any other questions. Still scrolling down.
Not yet. Any other questions? Now's the time, guys, if you want questions from Riz. While you guys go ahead and type that, Riz, what are you looking at this week? Is there something that you're keeping your eye on other than the conflict in Ukraine?
No, in terms of broadly speaking, no. The Fed catalyst is already done. Obviously, we got oil inventories every week. We want to see. I don't know exactly what economic updates are coming down, but usually there's something every week. I'm not too concerned about that yet. I'm more so looking at it from a technical standpoint, as the market can hold the 4,400 level and run back up to the 4,500 area. But conveniently, that's right above the 200-day moving average. So the 200-day moving average can act as a sizable resistance level. So let's see, right? I can't tell the future, and we're just going based off of technicals and historically what we've seen before. We did see, look at the volume candle there, right? Big volume candle. Confirming that run up. So could this be a sign of great things to come? Fingers crossed, because if it is, if we see markets go past 4,500, 46, 47, we stand to make a lot of fucking money. All right. And that's a fact. So my account already hit all-time highs, my personal investment account. And I've been very transparent with that. I feel like, you know what? If it does happen, it's gonna be fan fucking tastic, right? So everyone say a little prayer at night before going to sleep for the market. I'm joking. But on a seriously though, if we see a nice rally above 4,500, that's good. We want to sell into rallies. I think I don't want to be too greedy and then wait till we hit all-time highs to sell anything, right? Um, but yeah, that's my takeaway for the coming week. I will update, and this is only for elite members. I will share with them a strong conviction buy list. So list of stocks, some of them that I already hold that they know, plus some others that they can consider adding into if this market can continue to run. Those other positions will also continue to move up. So I will share that list of high conviction buys that people can consider. Again, I'm not telling people to buy anything. I'm just sharing what I own and what I have, plus things that I feel bullish on if the market can run. And then it's up to them to decide if they want to take that position or not. And that will be for elite members only. So I'm excited to release that.
That is always a fantastic resource for all of our elite members, and I think this is a great place for us to close the recording. We do have a couple more questions that we'll go over for everybody here live on the webinar. So all of you in elite who didn't make the webinar, who are watching on the recording, you got to get here. This is the good stuff. And for all of you watching on YouTube, if we open up membership again to elite, you're going to want to jump on that
Good
because
thing you remind me of that.
Yeah.
Good thing you remind me. We will be. So mark your calendars, ladies and gentlemen. If you're watching this, you're not an elite. May 4th. May 4th.
Star Wars
put
Day.
the waitlist page live soon, and you can then get on the waitlist. And hopefully, as long as you're on the waitlist, you're able to guarantee your spot. For those that don't get on the waitlist, I can't guarantee that you'll be able to join because again, we do cap the numbers just to keep it a good size and not too
Bloated.
clustered.
Yeah.
Yeah. So yes, I'm glad you just brought that up.
Perfect. Perfect. No, Star Wars Day, May the 4th be with you.
Yes, I swear, Chris, again, same thing. Like that is such a coincidence because I just May the 4th. Like I didn't even anticipate that.
Hey, we'll run with it. We're all about that here. So I'm going to go ahead and close the recording here for the people here live, but we will continue answering questions for everybody who's still here. And make sure, again, you click that like and subscribe button, and we will catch you on the next one.